Hello CFA friends. In this derivatives reading we will look at futures markets and contracts. So let's get started. Right, well you probably watched the forward reading already, and we spent quite a lot of time looking at various pricing and valuation formulae. So the first good news I want to give you here is that all those formulae that we covered there also apply here in futures. So we won't be reviewing the overlapping formulae again. We'll simply be focusing on the different characteristics of futures, so where they differ from forwards. Right, so firstly, the same principle applies here. When we are pricing a futures contract, we still want to use the no arbitrage principle, i.e. the idea that at initiation the value of the contract should be equal to 0. So we saw a formula, a cost of carry formula previously in the forward reading, that simply said the forward price is the spot price today minus the present value of any cash flows, such as dividends or coupons, compounded at the risk-free rate to maturity. Okay, so now in this formula we see both costs of carry as well as benefits of carry. The risk-free rate represents the cost of borrowing, i.e. the cost of carry. You can see that we are compounding the spot price at the risk-free rate, so higher costs of carry should increase and will increase the futures price. Whereas cash flows, dividends, coupons are benefits of carry, so these are cash flows that the holder of the equity or the bond will receive, so they will actually make the futures contract less attractive and will reduce the futures price. Okay, so by using this formula we essentially able to determine the no arbitrage price at initiation, where value is 0. Of course, the formula has many variations. We will see there are other benefits of carry that we'll encounter in this particular reading. Now, in futures we also talk about a slightly different concept that we don't mention in forwards, which is the concept of convergence. So typically before expiry the spot and the futures will differ, but as the futures contract matures there will be convergence between the futures price and the spot price, so that at maturity the futures price is exactly equal to the spot price. Well, think about it. If we've got a futures on a barrel of oil and our futures expires in, let's say, 5 minutes from now, well, this futures is almost as good as basically going ahead and buying a physical barrel of oil. So as we draw nearer to expiry, the futures will converge towards the spot. But anyway, let's prove this point with an example. So let's say there is a deviation between the futures at expiry and the spot. So the cash price or the spot price is $18 at expiry, whereas the futures price is 20. How could we make use of this arbitrage opportunity? Well, the arbor will buy the spot at $18 and simultaneously short the futures contract for immediate delivery. You can easily see that that will result in riskless $2 profit at the start of that transaction, instantaneously. So as a result of that, we cannot have this deviation. These two prices have to be exactly the same at expiry, and that's the idea of convergence. Okay, another key point and another key difference between a forward contract and a futures contract is the idea of marking to market. So remember, with forward contracts we typically, unless we've agreed differently, we are not going to mark them to market until the very expiry of that contract. It's a very different ball game in the world of futures. Futures are marked to market on a daily basis, right? So at the end of each trading day, as the contract settles, money is either paid in your trader's account or debited from your trader's account, depending on the movement in the underlying asset. So an interesting conceptual way to explain this is to say that a futures contract, for example, a 10-day futures contract, is nothing but a series of 10 one-day forward contracts. Well, why is that the case? Well, if I have a one-day forward contract that expires tonight, well, once that contract expires, I'll either get paid money or I'll have to pay money. And so the game starts again on the following day with the second forward contract. And that is exactly how futures work. They will be marked to market on a daily basis. That is the key difference between forwards and futures. Now, because they are marked to market on a daily basis, here's a big point. The value of a futures contract will reset to zero at the end of each trading day. Very important, this will not be the case in forwards. Forwards can have significant value before expiry, but the value of a futures contract will always be zero at the end of a trading day. There is a small trap here. If you get asked about the value of a futures contract's intraday, in other words, at some point during the trading day, make sure that you realize that there will be some value, even though this value is very low, there will be some value which is calculated as the current futures price at that point in the trading day minus the futures price at the last mark-to-market point, which will be the closing price of the previous trading day. Right, okay, well, we're not going to spend a lot of time on this slide because this is nothing but the basic cost of carry model from the forward reading. And in fact, a few minutes ago I showed you the more sophisticated version of this formula, which includes benefits of carry. But the point that we're trying to make here is that these are the formulae that we use in order to establish the no arbitrage price of both forward contracts as well as futures contracts. Right. So more or less this formula apply universally across the board. There will be, however, one exception when it comes to the formula for the Treasury bond futures. And why is that? This formula will be slightly different to the one we saw in the forward reading. And the reason is that when you have a short position in a Treasury bond futures contract, this short player has a valuable delivery option. Now remember, if I'm the short player, I have a commitment to deliver the bond at a future date. But I'm given a valuable option. In a Treasury bond futures contract, you can actually deliver any Treasury bond that has more than 15 years remaining to its maturity. And the reason why we do this because we want to prevent market manipulation. Imagine what would happen if each Treasury bond was tied to a particular contract, right? This could open us up to potential liquidity problems, even market manipulation. That is why the short player is given the option to pretty much deliver any one bond out of a huge universe of Treasury bonds out there. But of course, this also creates a problem. Some bonds have shorter maturity, some of them go up to 30 years, some bonds come with high coupons, some bonds have low coupons. So how do I standardize the delivery of these bonds? And the answer is we use something called conversion factors. Right? These conversion factors are calculated by the exchange on a daily basis. And essentially what these conversion factors do is they standardize the bond that you wish to deliver. For example, a bond with a high coupon rate will also have a high conversion factor. So how do we modify our pricing formula when it comes to Treasury bond futures? Well, again, we will take the cash price of the bond. We will apply our usual cost of carry, which is the cost of borrowing, or the risk-free rate in our case. And we will subtract any benefits of carry, such as the coupon. Again, whether you subtract the present value of the coupon first and then compound the whole lot, or whether you first compound the bond price and then you subtract the future value of the coupon, does not matter, as we discussed in the forward reading. What actually matters here and what changes compared to the previous formula that we've seen is the idea that this time we have to apply this conversion factor, i.e. divide by that conversion factor. And as we said, this conversion factor will be calculated for every single bond on a daily basis. Now, because these conversion factors only change once a day, even though interest rates may change during the day, it is sometimes possible for one of these bonds out of this huge universe of bonds to become what we call the cheapest to deliver bond, the CTD. And of course that's an attractive bond, because if you can identify that bond, this will be exactly what it says on the tin. It will be the bond that you can deliver at the cheapest price. Right, now moving on to the relative pricing of futures versus forwards. Now, which one's more attractive? Is it more attractive for me to buy futures or forwards on an identical underlying asset? Now, it all goes back to the correlation between interest rates and the underlying asset. So let's first start under the assumption of positive correlation between rates and underlying assets. So what's going to happen here? Now, if we've got positive correlation and let's say interest rates increase, this will cause the spot price to increase as well, right? Positive correlation. Now, if I'm playing with futures and I've got this mark-to-market feature we discussed, I am going to have mark-to-market profits at this point, being the long player. Now, of course, these profits will be paid immediately in my account, and I can then go ahead and reinvest them at these higher rates, which is attractive. Now, if rates had gone down because of the positive correlation, this would imply that the spot price of the asset goes down as well, and of course the long player will incur mark-to-market losses. Remember, the futures price tracks the spot price. But this time, notice what happens. If I have mark-to-market losses, I may end up getting a margin call, i.e. I may be asked by my broker to top up my account back to the initial margin. But notice what happens. If I need to borrow money, I now borrow money at lower rates. And again, that's attractive. So the upshot here is with positively correlated rates versus spot prices of the underlying asset, we would actually prefer the futures price to the forward price because of the attractiveness of the marking-to-market feature. So basically, in efficient markets, traders would be going for the futures price, therefore bidding it up above the forward price. Now let's look at the other side of the coin. Suppose we've got situation number 2, where interest rates and the underlying assets are negatively correlated. Now what that means is that if rates increase, that will cause the spot price to decline. And again, looking at our marking to market, that will now mean that we've got mark-to-market losses. But notice these losses occur when rates are high. So my margin calls are occurring when rates are high. So I need to borrow at a high rate. That is not attractive. Now, if rates had declined, then spot prices would have increased, and that would have given me marking-to-market profits. I like profits, but now if I want to reinvest these excess profits, notice I have to invest them when rates are low. Again, that is not attractive. So in this particular scenario, where we've got negative correlation between rates and underlyings, the marking-to-market feature that comes attached to futures contracts is actually not attractive. So traders will prefer the forward contract and will bid its price above the price of the futures. Excellent. Now moving on to, again, back to the idea of costs and benefits of carry. So we've discussed the big ones. The very big one that, of course, you will have encountered through the forward reading is the cost of borrowing. We discussed that we're using the risk-free rate as a proxy for that. Now, if you are trading commodities, there are a lot of other costs of carry you can think of. So, for example, if you've got gold, you will have to store that gold. So you'll have storage costs. You may have insurance costs. You may want to insure your gold against theft, for example. Some commodities are perishable, so you can think of spoilage costs as well. So the upshot is that the forward price will not only increase because of the cost of borrowing, but it will also increase because of any other number of possible costs, such as storage and insurance. Remember though, costs will cause the forward price or the futures price to go up. Now on the other side of the coin, of course, the benefits of carry. Now, of course, we've got monetary benefits of carry, such as dividends on your shares or coupons on your bonds, but there are also non-monetary benefits of holding an asset. That's an interesting one. What could that be? First of all, let's give it a name. The non-monetary benefit of holding an asset is known as the convenience yield, right? And we need to sort of try and understand what that's looking at. But before we move to the next slide and properly define it, I just want to make sure that everyone's clear that when you've got benefits of carry, they will actually reduce the futures price. So at the end of the day, we're not looking at anything more than simply the net cost of carry, which is storage costs, insurance cost of borrowing, net of convenience yield, and any other benefits of carry. So it's all about the interrelationship between costs and benefits of carry. Right, convenience yield is the non-monetary benefit from holding a physical asset. Okay, think of it as conceptually a similar, in terms of the formula, conceptually works similarly to dividends. Dividends are a monetary benefit from holding a share of equity. Now, convenience yield is the non-monetary benefit that manufacturers derive from actually holding the physical commodity. Say I'm a manufacturer who needs energy. Well, I can play with energy futures as much as I like to hedge my price risk, but at the end of the day, I need physical energy in order to operate my business. And the convenience yield of the commodity captures just that. Remember, it's a benefit of carry, so within our formula, it will pretty much work exactly the same way as dividend yield, and it will cause our futures price to decline. So now I think we are ready to have a look at the concepts of contango and backwardation and the causes of those two. Okay, let's start with contango. Contango is a situation where the futures price is above the spot price, i.e. we've got an upward sloping futures curve. So let's have a look. If the vertical axis is our futures price and the horizontal axis is the time to maturity. Now think of it this way. If a futures contract has no maturity, i.e. has 1 second to maturity, that futures contract is as good as a spot. So the y-intercept simply represents the spot price. And then from that point we can look at futures contracts with longer maturities. But if the curve is upward sloping, that situation will be referred to as contango. So for example, if I take the 3-month futures, I can see that that's higher than the spot price. And this is the most likely situation. But let's think about what actually causes contango. Let's think about our good old formula. How do we determine the futures price? And I'm not going to use mathematics here. I'm simply going to use words. So the futures price is going to be the spot. And mind you, I'm just looking at it from a conceptual point of view. That spot price will have to increase by the costs of carry and decline by the benefits of carry. Okay, I'm ignoring time value of money here. Of course, we will have to do some discounting, etc. But that's the concept. Costs cause the futures price to go up, benefits cause it to go down. So, to be in Contango, it must be the case that my costs of carry, such as the cost of borrowing, such as the cost of storage, are higher than the benefits of carry, such as dividend yields on financial assets such as equities, or convenience yield on raw materials, commodities such as raw materials. Now, the other side of the coin is a situation known as backwardation. Okay, we don't have too much space on this slide, so let's open up a whiteboard and have a look at what backwardation may look like. Okay, well, backwardation is a situation where if we plot the futures price against the maturity of the contract, here will be my spot price at zero maturity, and futures prices will be declining as I increase their maturities. So notice again, if I take my 3-month futures, notice that in this case the futures price will be well below the spot price. That is a situation known as backwardation. Now, what causes backwardation? Well, if Contango was caused by costs of carry exceeding benefits of carry, then backwardation must have been caused by costs of carry being less than benefits of carry. So a concrete example will be a situation where the convenience yield on a raw material is exceptionally high. That could bring our market in backwardation. Now, moving on to normal backwardation and normal contango. Okay, so this backwardation in Contango was simply the relationship between the spot price and the futures price. Now, very important, normal backwardation and normal Contango are not the same as backwardation in Contango. This is where we start involving the expected spot price of the asset. So, for example, normal backwardation will be a situation where the futures price is below the expected spot price in the future, right? So we no longer relate the futures to the current spot price, we relate it to the expected spot price in the futures. And similarly, so this would be normal backwardation. And similarly, if the futures price is greater than the expected spot price in the future, that will be a situation of normal contango. So, okay, we've defined what they are, we still haven't explained what causes them. So this time it's not going to be about costs and benefits of carry, it's actually going to be about the balance of hedgers and speculators. So remember, hedgers are players who either want the commodity or have the commodity and are worried about price risk. Speculators are parties who don't have the commodity and simply want to make a directional bet on the commodity. So, before we actually give the answer to what causes normal backwardation, normal contango, let's actually see how hedging works. Hedging, remember, is the idea that we want to reduce or eliminate risk. So let's say I've got the underlying in my possession. How do I hedge the worry, the price risk of that commodity becoming cheaper before I get to sell it? I use short futures. So an example here would be a farmer who knows that harvest is coming. Our farmer will have some wheat. The wheat's not going to come straight away. We have to wait 3 to 6 months, let's say. So we're worried about the price of wheat going down. So how do we hedge that? We go short wheat futures on the exchange. So in the event that wheat does actually get cheaper, we make profits, generate profits on the short position. So for that reason, we will refer to the farmer as a short hedger. Okay, because they are going short the futures. Farmer owns the wheat, goes short futures. Now, who may be short the underlying, and what does that really mean? What does it mean to be short the underlying? We basically mean you need that underlying. So, for example, if I'm a consumer and I want wheat, then I'm essentially currently short that underlying, and of course I'm worried about the price of wheat going up. How do I hedge this? Well, of course I hedge this by going long wheat futures. So in case the wheat price goes up, then the long futures generate profit. So the example here would be a consumer, and because our consumer has to go long the futures in order to hedge the risk, we refer to consumers as long hedgers. Okay? Now, it's all about this, guys. It's all about this, guys. Are farmers more concerned with price risk, or are consumers more concerned with price risk? That is what will determine whether a market will be normal backwardation or normal contango. So, let's have a look at this. Suppose all the hedgers are on the short side. So, short side means they're short hedgers. I suppose we've got a lot of very nervous farmers. Okay, farmers are super nervous that the price of wheat may go down. So they've all gone short the futures contract. Well, basic supply and demand tells me that if I've got a lot of sellers, i.e. short futures players, the price of the futures will decline. And therefore, the futures price will end up being below the expected spot price in the future. So expected spot price, this is simply the idea that there is a consensus expectation of what we think wheat should trade at 6 months down the road. But because we've got all these nervous wheat farmers bidding down the futures price, we'll see the futures price actually going below the consensus expectation. And that is a situation known as normal backwardation, because you got the futures price below the expected spot price. All right, this is going to occur when we've got a lot of short hedges. Or you can think of it also from the point of view of the speculator. Now, if my farmer's going short the wheat future, who's going to take the offsetting transaction? Of course, it's going to be some speculator. The speculators in this case are taking the long positions. Now, they will be taking a directional bet on the price of wheat. They're expecting the price of wheat to increase. But of course, they won't do this for free. They will require some form of compensation in order to accept this risk. And this comes in the form of the difference between the actual futures price at which they are committing to buy and the consensus expectation of the futures price of wheat. Now, a very, very similar argument exists for the explanation of normal contango. Now, suppose this time we've got a lot of nervous consumers. Now remember, consumers are long hedgers because they need the commodity. They know they'll have to buy the commodity at some point in the future, so they're worried about price increases. They go long the futures. So you've got a lot of these long futures players. They're gonna bid up the price of the futures contract to a point where the futures price will exceed the expected spot price in the future. And of course, this will be referred to as normal Contango. Okay, almost there, guys. A couple of more slides really here. We're going to briefly talk about Eurodollar deposits versus treasury bills. And remember the lingo. Eurodollar is a dollar that has been deposited outside of the United States. And so these Eurodollar deposits are typically linked to the London interbank offer rate, also known as LIBOR. So for that reason, it is not surprising that we use a 360-day count convention. In the forward reading, I did give you the tip that whenever we see any instrument that is based on LIBOR, we will be using simple 360-day count convention. And of course, we know LIBOR is a floating rate at which big banks lend to each other. Now, but what is the key difference between a Eurodollar deposit and a T-bill when it comes to the calculation of interest? Well, Eurodollars use add-on interest. What does that mean? It basically means that if Bank A lends $1 million to Bank B, at the end of the term, I don't know, 30, 60, 90 days, we'll have to pay back that famous 1 million, plus added onto it, we have to pay some interest, right? So the face value, if you want, of this deposit was $1 million, but when we reach the maturity of deposit, we'll get more than $1 million. Now T-bills, again, they can come in a face value of $1 million, but they are pure discount instruments. In other words, you may have to lend 980,000 to Uncle Sam today, and in return the US government will pay you $1 million in 90 days, let's say. Okay, so that's the difference. The first instrument is add-on, pays the interest on top of the initial 1 million. In the case of a T-bill, we've got a discount instrument, so we generate the interest, if you like, in the form of a discount from the face value. Now, why is that important? Well, the reason why I'm mentioning this is because, unfortunately, Eurodollar futures cannot be priced using our standard cost of carry models, because all those cost of carry models assume that some form of arbitrage transaction should be set up in order to ensure the price is correct. But of course, the problem here is, as we said, Eurodollar deposit use add-on interest, whereas T-bills are discount instruments. So as a result of that, arbitrage transactions cannot be constructed perfectly. Okay, well, I guess this is just a wordy question. There's not much you can do with this other than basically learn it as a fact. That is my best advice here. Guys, we're nearing the end of this fairly short reading, I should say, on futures. So what were the key things we saw? Well, of course, we saw that futures are pretty much the same type of animal, such as forwards. So pretty much, to get a good understanding of what futures are, pretty much go back and look at the forward reading video. But on top of that, we did see there were some differences. For example, futures were mark to market, forwards were not. Also, if you had a treasury bond futures, you had to worry about the so-called conversion factors. And of course, due to movement in interest rates, you could effectively end up with the so-called cheapest to deliver bond. Also, we looked at the relative pricing of futures versus forwards. We realized that the correlation between rates and the underlying prices was very important there. We again reiterated the idea that costs of carry increase the futures price, whereas benefits of carry reduce it, and we mentioned an important new word known as convenience yield. We finally defined backwardation and Contango, which of course is all about the inner relationship between costs and benefits of carry, but we also looked at normal Contango and normal backwardation, which was about whether our hedgers were going to take a long position or a short position. Guys, thank you very much for watching this video. I hope this was helpful to you, and all the best in your studies. Goodbye.